would like to thank our sponsors, Western Union Business Solutions and FireApps, whose commitments to supporting thought leadership in the arena of FX risk management have made it possible for Proformative to bring you this program for free today. Today, we will hear a joint presentation from Andy Gage and Carl Schmada, and then we will spend the remainder of our time in an open panel discussion. We would like this to be an interactive experience for you. So if you have any questions at any time, please go to the questions area in your GoToWebinar control panel and send us your questions. We can't promise to get to all of them, but we will do our best and will follow up afterwards on any questions we do not get to. Please note that we will send out soft copies of this presentation to all attendees later today. Also note that we are offering CPE credits for the CPAs in today's audience. If you would like CPE credits, please send an email to twalsh@proformative.com. That's twalsh, T-W-A-L-S-H, at proformative.com, PROFORMATIVE.com, in order to receive your CP certificate. Don't worry, if you didn't catch that email address, Tanya will be the one sending you the webinar survey and presentation slides later today. Okay, let's get started. I'd like to introduce our speakers, Andy Gage and Carl Schmada. Andy Gage currently serves in the role of Vice President, Strategic Market Development at FireApps. Andy has over 20 years of experience in consulting, product management, and marketing. Again, he is currently the Vice President of Strategic Market Development at FireApps, where he advises corporations, consulting firms, and business partners on a wide range of foreign exchange exposure management topics and emerging industry best practices. Prior to his tenure at FireApps, Andy held management positions at Cyclone Commerce, Deloitte Consulting, and Syntex Pharmaceuticals. Andy holds a BS in Business Administration from the University of Arizona and an MBA from the University of Texas, Austin. Carl Schmada currently serves in the role of Senior Market Strategist. Carl has designed and implemented risk management and trading strategies for hundreds of companies ranging from small businesses to large corporations. As a member of the Business Solutions Analytical Team, Carl also provides market analysis and strategic guidance on a daily basis for thousands of international businesses. Carl is a regular contributor to a number of international treasury and finance magazines, and his market analysis and forecasts have been widely quoted by such publications as Washington Times and the Wall Street Journal. With that, I'd like to hand over the floor to Carl Schmada, Senior Market Strategist, Western Union Business Solutions. Carl?
Thank you very much, Ernie. Thank you, everyone, for joining us for the third session here for our third webinar. Today, what we're going to be discussing is really a technological framework, the nuts and bolts behind your risk management policy. And to sort of open that up, what we're going to do is discuss the topics that we've already covered, the risk environment and the risk framework that should underlie the technological architecture that your company will deploy. And we're then going to talk about some real-world application here, provide some case studies of companies that have actually employed this architecture and used it in a number of different ways, from full cycle all the way through to those who have picked particular pieces off the shelf and deployed those. So the first thing that I'd like to talk about here is the risk environment that we're dealing with, and we really covered this in our first webinar, talking about the fact that as the globalization process has occurred around the world, companies have gone farther and farther in search of cost efficiencies and revenue opportunities. And this has meant that exchange rate movements have a much more material effect on companies that operate internationally, and effectively severely impacts balance sheets and cash flows for international business these days. At the same time, the same globalization process has brought the world much closer, and it has made the currency markets themselves more vulnerable to extreme moves. As Wolfgang mentioned in our first webinar, an event in Libya can have a direct impact on the US dollar these days. And as we saw last week, a slide in the commodity markets can cause currency markets to reverse direction very, very swiftly and cause immense damage for companies that are exposed to exchange rate movements. Ultimately, what does this mean? It means that forecasting exchange rates is extremely difficult, and that companies need to find ways to understand the exposure that they have and manage the associated exposures. Now, in our second webinar, we talked about a risk framework, and basically a policy or a process that companies can deploy to manage the associated risks, and really we broke that into 4 steps. Firstly, to identify the exposures, get an understanding of the lay of the land, then build a strategy around that to achieve the objectives required, and then to execute on that strategy and actually enter the market in an effective manner, and then continually adapt to changed circumstances and changed objectives. And ultimately what we want to do is talk about technology as supporting that framework. So we want to map the technology to the process, not the process to the technology. And what do I mean by that? All the bells and whistles are really nice, but they can get in the way of achieving business objectives. So I think you're going to hear a theme throughout Andy's discussion here today, and that's going to be that we want to make sure that this architecture actually supports the process. And ultimately that means that you need to understand the business requirements first. And Andy, if you want to discuss some of those requirements that would inform this process.
Sure, and as we go through the course of the case studies today, you'll see a wide range of deployment models for different pieces of the exposure technology. But generally what we're seeing is a trend for companies that really want to get out ahead of the curve in managing exposure to really automate as much of the workflow as possible. And that's really to deal with the increase in globalization as well as the increase in volatility. Both of those things are conspiring to really make it very difficult for companies to really understand and manage their currency risk with a very dynamic and constantly changing environment. So there's a very strong appetite for the automation of exposure capture to decision management to trade execution and post-trade accounting. I think the other thing that's also driving a lot of thinking right now is given the constant push for increased productivity and Treasury being asked to do more and more strategic work across the organization, that automation is also driving up the obvious increase in efficiencies from a Treasury standpoint, but it's also reaching out to the business unit finance and accounting. There's a number of companies that are still out there today that rely very heavily on their constituent business partners in the field to take part in the exposure definition or forecasting and providing that information to Treasury, also working with accounting on the post-period FX gain loss analysis. Just puts a lot of additional work into the business units, and there's a real desire to automate as much of that as possible and really reduce the potential for people making mistakes, whether it's in calculating exposures or doing any analysis or even in a worst case scenario in executing trades. I think the other key aspect that we're seeing, and this is really coming from boards, it's coming from auditors, executives, is a fundamental increase in transparency and timeliness. When currency markets conspire against you, it doesn't happen gradually. It can happen very, very quickly, and it can be a result of a large directional move on a currency, or it can be a result of some internal mechanism or internal accounting process going awry that creates a surprise. So being able to have visibility across the entire enterprise as to really what's driving the exposures and having that at your fingertip in some sort of a dashboarding format is becoming a fundamental requirement in numerous organizations. Trade execution, the ability to automate the trade execution and then take advantage of pricing leverage in the market is also becoming more and more of a focal point. But as you lay all of this stuff in place, you can't lose sight of the fact that there's a constant push for increased compliance and control. So having a process that's completely auditable from cradle to grave that can pass both internal and external audits is really key. And then finally, you need to have something that's in place that's not going to be wed to how you've done it in the past or how you're doing it today, but is going to set up for the fact that your company is going to continue to grow and probably grow through acquisitions into more and more emerging markets that bring a lot more risk with them. So those are some of the fundamental requirements that we're hearing from the marketplace, really from top to bottom, whether it's starting with the exposure capture to trade execution and all the way down to the post-trade accounting. Carl?
Yeah, so effectively what we're looking at is the technology needs to support 3 broad areas. The first is capturing exposure data, generating data on the cash flows that may impact the business itself, and then secondly, identifying and managing the resultant risks that are popping up. executing offsetting financial transactions with your external counterparties, and then tying all of that together. And that's really the key, is making sure that all these systems are talking to each other, and that the data is moving through the process efficiently.
Great. So as you begin to think about how currencies impact a company's financials, this is a great model to begin to kind of compartmentalize some of the major sources of currency impact. So if you think about a typical income statement where you've got your revenue, your cost of sales, operating expenses, you have your net, basically all the things that we refer to as above the line. Those are going to be impacted based on the cash flows that are coming through on revenues and COGS. Those are typically things that are forecasted in nature as companies begin to try to understand what their exposures are and develop a policy for hedging. But there's also a lot of value in the information that has historically been captured around the business. If you go below the line and you think about the items that come off of the balance sheet, the monetary assets and liabilities that when remeasured are going to create an FX gain loss, those are typically being recorded within your FX gain loss line in other income and expense. And to really have a holistic framework in place, you need to have an ability to understand your exposures both from a historical, potentially from a forecasted perspective, whether it's above the line or below the line. It's critical to, at minimum, make sure that you understand what those exposures are so you can determine, based on our earlier webinars, what your risk is and your comfort as an organization on your risk tolerance. If you go to the right side, there's a business decision based on your understanding of your exposure and your risk as to how, and in fact, whether or not you actually want to manage that risk. So when you're managing the above-the-line exposures, those are going to be looking out at forward-looking cash flows, 12, 18, 24 months, trying to understand how those things are going to be impacting the organization in the currencies that you anticipate doing business in. And then below the line is really understanding how things are going to be remeasured on a month-to-month basis, and there's a lot of things that go into how that's done. And that's where you may be simply looking at organic or natural hedging opportunities as a way to manage that exposure, or looking at using the derivative markets to hedge that. So it's good to frame up your overall understanding of exposure and risk and what the appetite for managing that risk is. Now, what you'll see a lot of companies doing is starting to think about the underlying infrastructure that's required to do this across the enterprise. And this slide here really represents many of the elements that Carl mentioned earlier in terms of the technologies that are now currently available for companies to understand, manage, and execute in this environment. So on your left side, these are going to be the sources of data. This is where the exposures exist in the business today. These could be your SAPs, your Oracle, your PeopleSoft systems, accounting systems. They can be planning and consolidation systems, and quite frankly, they can be spreadsheets. Typically, when you're looking at the cash flow forecast, a lot of that stuff is done based on worksheets coming out of the FP&A group. Having the ability to take information out of those existing environments and bringing it into an environment where you can begin to aggregate that exposure, harmonize it, rationalize it, analyze it from not only do I understand my exposures, but do I actually believe the integrity of that information is really critical. The next step is then executing your policy. So what recommendations or what decisions do you need to make? That information is then typically packaged up into a trading execution if you're going to go to the derivative markets, which would be passed off to a trading engine such as the ones provided by Western Union and others. And then from there, it's going to be handled downstream to a treasury management system to handle the post-trade accounting, or if you're doing FAS 133, your FAS 133, FAS 133 accounting. Now, it's important to state at the outset that this is sort of the emerging reference architecture for all of these components: exposure, pre-trade exposure analytics, trade, and post-trade. But as you know, the reality of the world is, we all have to deal with. Not everybody has all of these technologies in place. So the presentation that I'm going to walk you through today is going to be a case study of really companies at different levels of maturity in terms of their exposure management and their technology stack. And we'll give you a sense on how companies are working with their existing exposures given the limitations of their technology stack that they have in place today. So as we move to the next slide here, I'm now going to focus on a case study with a company we call a company out of Boston, Nuance Communications, and really where they were. Just a little bit of background on them. They're roughly a $1 billion company, significant international operations. A lot of their business is done outside of the U.S. And they really grew into a risk environment that, quite frankly, they were not comfortable with. So if you go back in time, and one of the things that they recognized is they took a very significant foreign exchange hit about 2 years ago, and that impacted them about 1 cent per share. And that was enough to motivate a lot of people to take a very hard look at it, because historically they had been seeing FX impacts really on the plus side. So historically FX gains were the norm, began to experience the unacceptable losses, and that drove Treasury to begin doing an internal assessment, really going in and trying to dig in to their exposures by currency pair, trying to understand how that was being brought together, and really went through it what is quite common of just doing an internal exercise using spreadsheets. What they went through in that process created an exposure definition for them, but they recognized that the time that it took to bring that information together, the fact that they didn't have all of the information that they needed, and very quickly they were able to isolate specific errors that they saw in the spreadsheets with just a very brief audit. They really didn't have any confidence in that number, and they had a lot of pressure from them to really see what is going on to manage that risk. So as you look at what they tried to do from there, is they implemented a very straightforward environment. They had Oracle as their accounting system, which contained for them their major source or focus of exposure was their balance sheet exposures. They used Fire Apps to aggregate the data from that accounting system and really help them dig in and understand what was happening from an exposure standpoint. So as you dig into what they were doing is a very nice analytical environment where they were able to look at their exposures by currency pair. They were able to look at it on a corporate level. They were able to break it down by entity. They were able to segment it based on monetary asset and liability class, and even down to specific general ledger items within their Oracle system. A lot of insights came leaping out of them as they did that. One is we see a lot of information telling them about their intercompany balances. There was a lot of noise within their intercompany. They created a very distorted view of their exposures. They were able to use the ability to look at data over time, to look at the trends and help them figure out what were the patterns that they should be looking at in terms of how they would forecast their exposures. And they were also able to do a very nice cost-benefit of managing their currency risk. So once they understood their risk and they could look at what the risk reduction opportunities were, they could see how much it would cost them or potentially generate interest income based on the underlying interest rate differential. So a very rich analytical environment on that. Now what they did once they had that confidence in that data and they'd isolated it down to what their exposures were, is they went into a process where they simulated their hedging program for a period of months. And really what they wanted to do there was go through that process once they had agreed upon what their exposures were, develop an exposure forecast based on historical trends and organizational input, and use that to create a series of hedges for a period of months where they could track what the actual results were versus what the anticipated results were. And as they went through that, they did some additional post-mortem FX gain-loss attribution analysis, identified some things that they were doing internally that if they changed the behavior on or the timing of, could improve their overall effectiveness of their program. And that was really the basis for them of creating the executive report that they took to the CFO and the broader risk management staff or steering committee to ensure everybody that, yes, we do understand our exposures. We do understand how to protect the firm. We've proven that we can hedge in this environment, and we have a good idea of what the anticipated results would be. And that was enough for them to get the endorsement and approval from the executives and the board to go ahead and embark on their hedging program. And they still have that same monitoring and control environment in place for them as they go through this on a month-by-month basis. So this is an example of really just starting from the bare bones, really focusing on the first block in any exposure management or risk management framework is understand your exposures, understand your risk, the cost benefit of managing that risk, and then implement the processes appropriate to do that. Carl, Ernie, do you guys have any questions or input on this?
Just where have you seen this go wrong? What areas of inefficiency occur in this process?
That's a great question. I think one of the things that you see when you start opening up the data, a lot of times companies have suffered from sort of anecdotal evidence of problems within the way that companies do multi-currency accounting. And when you begin to put the lens on this, that opens it up, really provides a portal back into the business that says, here's really what's driving your exposures, a lot of things come out. And sometimes those epiphanies, if you will, can cause an organization to really have to sit down and rethink how they do things. Intercompany is notorious for that. So it does require it to be successful that you do get a very cross-functional team oriented around looking at this. They may not be necessarily involved on a day-to-day basis, but you need to have participation from obviously Treasury, some support from IT, from the people that maintain the underlying accounting systems, but very important to have participation from accounting, potentially tax, as well as the business unit. So as issues come out in terms of understanding the exposures, you've got the proper team in place to understand how to potentially identify and remediate issues as they come up. So kind of the lessons learned from the team, and we actually just presented this case study with the team from Nuance last week at TMAIN. What they felt they had out of that was a very effective process for looking at this across the enterprise. Getting the automation in place and replacing the spreadsheets and the guesswork really took a lot of error out of the equation and increased the confidence. But to the last point, based on Carl's question, they also recognize that this is a journey. They're not done. There's still ample opportunity for them to continue to seek opportunities to increase efficiencies, either from an operational standpoint or from a transaction execution standpoint, and there's always opportunity to continue to reduce risk. So let's take to the next stage here, ADC Telecom. ADC Telecom was a bit further down the path in their program. And what they recognized early on, well, let me give you a little background. They're about $1 billion in revenue, actually just recently acquired by Tyco Electronics. But prior to that, had a very lucrative business operating in a lot of different countries. And a lot of their exposure was generated as a result of their overseas sales, but a lot of it flowed through the business in the form of intercompany exposure. They recognized a couple of years ago that similar to what Nuance experienced, there was going to be a change in the dynamics of their business where historical gains were going to become very significant financial losses for them. And they recognized that they didn't have a proper framework in place to deal with this. So like Nuance, they did have a process where they were trying to pull information out of their accounting system, in their case SAP, and they had historically used reports and spreadsheets to derive that exposure, but they could never get comfortable that they actually had the right information at their fingertips. And just due to the time and effort that it took to get the data out of SAP and into an analytical framework, really reduced the scope and capabilities of their overall exposure management program. So by layering in the FireApp solution, as well as beginning to lay the foundation for trading at a much higher level of trade execution, they realized once they did this, they were going to expand their currency footprint from 4 to 6 currencies to 16 to 18 currencies. They wanted to make sure they had effective exposure management and trade execution to deal with that increase in volume required to protect the firm there. So FireApps in this case is working directly with pulling information out of SAP, all monetary asset and liabilities, again, a very much a balance sheet focused process, but they also included data from other parts of the business that were not on SAP or required adjustments to the actuals, went through the same process of analyzing the exposures and having the system recommend trades. And in this case, the trades go out to a trading platform, and the trading platform provides information back into the FireApps environment so the company can see at any given point in time what their gross and net basis of their exposures are. One of the side benefits of this process for them is prior to doing this, given the painstaking process that they went through historically, they were able to move their program from a once-a-month snapshot to once or twice a week snapshot and continually monitoring and adjusting their positions in the marketplace to drive down the exposure impacts. And one of the things that they found very quickly as a result of taking this much more automated approach from exposure capture to trade execution is they found that within the first 6 months of implementing this automated process, they eliminated $3 million of foreign exchange losses. They also recognized that their more institutionalized and robust process identified 30% exposures that they were historically missing due to gaps in the reporting and spreadsheet processes. The bringing in of additional information from other business units helped them further their understanding of their exposures. And just based on that automation and that analytics, they were very quickly able to increase their hedge coverage by about 50%. So hedging the existing currencies that they were hedging to a higher threshold and expanding the portfolio. I think the ultimate testament to the results of this fully automated process for them, short of having a treasury management system, is the fact that at the end of the day, they were able to take a very chaotic FX gain loss line for the first half of this and really drive it down to a very straightforward performance. And as you can see here, early on, lots of volatility, not really able to stay on top of that. Their hedges were not really tracking where they needed it to go. And as they implemented the processes, they really drove down the exposure and the risk and the results to a very acceptable framework. Any additions to this, Ernie or Carl?
Just one thought there. When a company is evaluating the volatility of the P&L, how do they do that? How do you recommend that they do that?
Well, what we always recommend is it's always good to go back and look at the overall FX gain loss on an aggregate basis as well as on a business unit basis, because you will see some diversification. But just being able to monitor the FX gain loss lines and being able to get comfortable with how much of that you can explain is a good way to see how it's been modeled. And the big question you have to ask the organization is, how much volatility is acceptable? Because there can be cost of managing that volatility, and just doing it in the format that you see here is it's a great way to begin to understand how much risk you have in the business and what's possible. The other approach that we've seen to be very beneficial is once you have a complete understanding of your exposures, you can do what we refer to as a core analysis, which then takes into consideration your exposures. It'll calculate your risk. And then based on the interest rate differentials on the hedges that you may or may not choose to execute, you can look at how much it can cost or how much interest income you can generate based on the interest rate differential. So it really allows you to do an analysis of the cost and benefit of the overall hedging program. Okay. Now, one thing I will comment on here, because I'm about to show sort of the full straight-through process, is you'll notice in the ADC case study, they have the exposure and analytics, and they have the trade execution. Really fundamental. This is where we see a lot of companies investing first, just to getting down to that efficient exposure analysis and efficient trade. That can do a lot for a lot of companies, and you will find companies that ask the question of, well, how do I handle trade management? How do I handle some of the post-trade accounting and mark-to-market activities? Now, typically that is in the area of treasury management systems, and we have partnerships with any number of them that can help execute on that. But for some companies, they cannot necessarily invest or make a business case for buying a TMS just to satisfy the requirements of foreign exchange. And if you're a very fast-growing company doing a lot of business internationally, your foreign exchange issues may become much more of a predominant issue than your cash management issue. So the business case for a TMS may be a bit difficult. So we're seeing more and more companies asking for sort of this lightweight trade management capability to really offset the requirement to go get a full TMS. So in that environment, I think it's important to talk to your business partners like a Western Union or a FireApps to see how they can accommodate some of those issues instead of having you go out and invest in a full TMS environment. That being said, a TMS does play a very critical role in a very mission-critical foreign exchange process. So let me now shift gears and talk about what I believe to be one of the best implemented straight-through processes for foreign exchange in the marketplace today, and that's with Agilent Technologies. So a little background on Agilent. Agilent Technology is actually a spin-out of Hewlett-Packard. They came out of Hewlett-Packard as a roughly $4.5 billion company, kicking and screaming. And if you know anything about HP, they have a very aggressive risk management program. So they came into life with a very heavy focus on managing risk. They had built up their own processes over the years, but they had also helped, the way in which the organization was designed from the get-go in terms of how they record information within the Oracle environment, how their businesses are set up, did set up a more simplified currency risk management program from the foundation. So they simplified some of their intercompany structures, and they had worked very hard to ensure that the underlying data within their Oracle system was as clean and accurate and compliant as they possibly could. Now, when they built out their system historically, they had a system that was very much a portion of spreadsheets, working with the treasury management system, but it had become very cumbersome for them to manage this with the business continuing to grow into the emerging markets and other parts of the world. So their focus, when they really wanted to upgrade their entire treasury technology stack, was to achieve that capability for a straight-through process, to really make sure that they had a holistic understanding of top to bottom impacts on the income statement, and shift their focus from data management and data aggregation to analysis and decision making throughout their entire treasury stack. So from a foreign exchange standpoint, this is a schematic of that same view of exposure to pre-trade, to trade, to post-trade. In their environment, they had Oracle as their back office system, and they really had two programs that they executed through this environment here. One was very much focused on managing the balance sheet, and the other was focused on managing the cash flows. The balance sheet was based on a forecast of the balance sheet. So in their environment, we were able to use multiple prior periods of information in a business intelligence environment. So when they started their monthly program, they would, or monthly hedge process on the balance sheet, we would start with 3 months of historical data. We would use algorithms such as some weighted averages for certain parts of the balance sheet that were more consistent period over period. We were able to incorporate growth factors based on sell-through into the channel and through their intercompany relationships to forecast what they thought those were going to be. But at the end of the day, through a variety of data and parameters, they developed a very powerful and robust forecasting process for forecasting the entire balance sheet. And then same thing with the other clients. They analyzed the data, made their decisions, and in their case had a trade management function that sent the trades to the trading platform, but also parceled out certain trades that they wanted to do directly with the bank because they wanted the benefit of the financial services partner to help make sure they were making the right decisions in the local markets. The executed trades were then passed through the treasury management system, and that information also comes back to FireApps to again provide the holistic understanding of both gross and net. Now, one of the key tenets of this is to also make sure that they had the ability to do the internal and external trades. They basically have a back-to-back process. So through this orchestration across these various component technology providers, we were able to engineer a solution there where they can actually have a very efficient trade going out at a corporate level through the trading platform, but also making sure that they understood what trades needed to be allocated back to the underlying entities. So that process is fully automated. Information flows through the entire process, and has proven to be extremely powerful. On the cash flow side, similar approach in principle, but slightly different in that instead of doing it once a month, they have a quarterly process, but again, using historical data as a starting point, they would understand what their currency mix is by currency, by revenue, or by cash flow line, by business unit, and also from that, they're able to determine what the currency mix is. From there, they shared that currency mix with their business unit partners, who would then come in and change or augment or accept what the historical currency mix is. They then use those ratios to pass their cash flow forecast that comes out of the FP&A group on a US dollar basis through that currency mix to create their multi-currency forecast 12 months out into the future. That was then the basis of their decision making. They did a layered approach there where, first quarter they may hedge it at 90%, second quarter maybe at 70% and on down the line. And all of that information, again, was packaged up in terms of hedge instructions that went through the trading platform and the TMS. So a very strong straight-through process from cradle to grave on that. And really, when you look at what the results of their solution to date have been, very, very adaptable to the ongoing changes within their environment. They can add new businesses in through acquisition very quickly into this environment. They're much, much more efficient, not only within Treasury, but also within the business units that are participating in that consensus view of the cash flow forecast. And given that the information is all within a single analytical environment, they have a lot more transparency top to bottom to the impacts of the income statement, and they're able to tailor reports to different constituents as well. I think the other thing that was also very critical for them and really has proven to be very, very robust is being able to ensure that they have proper compliance and control. They have now gone through multiple internal and external audit reviews of the entire process, and they feel very comfortable that everything is fully documented, processes are well in place, they've got proper separation of controls all throughout the entire process. So their process is very much a bulletproof process from cradle to grave. Ernie, Carl, any questions or thoughts on that?
No, not from my side. Thanks, Andy.
Okay, great. Well, really what we wanted to do in the context of this presentation here was really provide the people that have been participating in our surveys to date is really kind of a glimpse into how different companies at different levels of maturity have applied technology to really understand the best way to manage their currency risk. So we've given you an example of a company that really was just starting up, a company that's had a very robust program, and then a company that's really taken the straight-through processing to an art form. And hopefully you've learned something from that. Obviously, if you have questions or would like more information about this, please contact us either through the Western Union website or through the FireX website. We've got a lot of additional information that we can share around emerging best practices in how technology can be an enabler of a world-class FX process.
Okay, great. Thanks, Andy. So now I'd like to open up the panel discussion and Q&A for our audience. First and foremost, I need to apologize for some of the audio issues that we were having previously, so I'd like to just take a step back and do a little summarization of the content for those of you who are having some audio issues. So I think that in synopsis, the first part of the webinar was really devoted to stressing, once again, that you have to have the appropriate alignment of people and process before you even get to selecting that right technology. And then as Andy mentioned, it was fantastic to go through those 3 different case studies to be the most relevant to the different situations of the corporations in the audience. So someone who is just starting out on the cusp of this, and then there's someone that's a little bit farther advanced, and then take you to kind of the best and the brightest on that case study. So I think that sets a good tone for us here. So with that, I'd like to direct my first question probably to Andy, and then Carl, feel free to comment. How do budgeted FX rates drive the FX risk management strategy, and how do you choose them strategically?
Carl, you want to take that one first from your standpoint, because I probably have a different view on that, but why don't you take a first snap at that?
Absolutely. I guess first observation I'd make there is that the budget rate for an investment in a foreign asset should normally be the exchange rate that was in place at the close of the previous fiscal year or the last reporting period. So that's relatively easy to hedge, and you can match it up with reporting periods relatively easy. Now on the other side, the way we like to look at this is more rather than taking a market-focused view. I would suggest taking more of a margin-focused view, understanding the pricing strategies that the corporation uses, and determining the profit margins involved. From that, determining what break-even exchange rates might apply, and then using that as a basis. Trying to forecast where the market itself will go, or using a really written in stone exchange rate is pretty much a recipe for hedging decisions down the road that will lead to greater inefficiency.
Yeah, I would agree with that. And I think what we also see really on the balance sheet, which is quite a bit more dynamic, because you're dealing with a constantly changing set of rates, and you're trying to match your hedges, which are typically shorter in duration with the underlying exposure. We typically see a couple schools of thought. One is going to be looking at the hedge, or the balance sheet rate is going to be some derivative of the prior month. It's going to either be the end of the last month, or an average of the prior month, or a weighted average of the prior month. And typically in that environment, you're going to have companies that want to match their balance sheet rate with their hedge rate. So as quickly as possible, come to the consensus of what their exposure is so they can put the hedges on as close to the balance sheet rate as possible. And in that environment, you typically do a lot more forecasting, even of the balance sheet. And that's in this case here, that's exactly what Agilent technology was doing. We are seeing an interesting trend, and we're not sure if it's a macro trend yet. There seems to be a micro trend right now, given the surge in volatility and some of the material impacts that we've seen in the income statements. On the balance sheet, we have seen a subtle movement towards companies adopting more of a daily rate environment. And that really does change the dynamics there. It's going to force you to look at managing your exposures on an actuals basis, and certainly adds a lot more complexity to the FX gain loss at the end of the month. But there's a variety of drivers as to why companies do that. Either it's driven for statutory reasons, it's driven, and we're seeing a lot of pressure from auditors trying to explain the results. And you know, at the end of the day, from the risk management standpoint, you just have to be able to understand what's the best way to understand the exposures and map your program to the appropriate environment.
Yeah, and I don't know if you're seeing the same thing, but you know, you're seeing a bit of a shift away from the linear hedging instruments such as forward contracts towards more average rate instruments that you know, pay out on an average rate basis that match those daily moves.
Yep.
Okay, great. We have another question, and I know you don't want to get into too much specific brand talking, but just from your experience and what you're seeing, someone's asking, you know, if there are certain treasury management systems that seem to work best in the arena of global FX management. I know it's always a challenge to get the systems to communicate with each other. You know, are there any systems that you're seeing out there that are trending, new developments, maybe a cloud or SaaS system, or any system that seems to be good at communicating across the ERP, treasury management, and maybe the software that you have, Andy?
It's a great question. I mean, I think if you look at just about all of the major providers out there, they all provide a decent level of support for FX. One of the things that you do see is there are two different schools of thought in how treasury management systems support the FX process, and I'll give you the examples of that. If you look at the workflow that was constructed there for Agilent Technologies, the process basically went from exposure management to trade execution, then to the treasury management system. And that's probably the prevailing approach that we see out there, where external trades and internal trades need to be sent to the TMS so they can do the reconciliation there. There are certain vendors out there that really want to put the treasury management system prior to the trade execution because they want to leverage the trade management functionality within their environment, and they've already got plug-in hooks to the likes of FXall or other trade execution environments. You know, we don't have a strong opinion one way or the other, but I think that latter process is becoming less and less attractive to a lot of companies because they do really want to see a single view of their exposures in a single environment versus having it spread across multiple areas in there. But at the end of the day, you know, if a company is providing exposure or FX capabilities, just make sure you understand what it is that you're looking for out of their FX solutions there. If you're looking for strength in FAS 133, there's some obvious, you know, best-in-class capabilities. If you're looking at it just for, you know, core FX processing, I think the general population of your typical vendors do a very good, if not, you know, very, very good job at managing that.
Okay, I think there's a little bit of a follow-up question, and I don't want to put you on the spot. Just in terms of size, in terms of, you know, who you think are the biggest players out there, the top 3 or 4 names that you see in treasury management systems, is that something you can share with us?
Yeah, I'm happy to do that. I mean, I'd say the big 2 are going to be your SunGuards and your Wall Street systems. Those are going to typically be playing in the companies that are 3 to 5 billion and above, and they all have solutions that really tailor to the different levels of the corporates that are out there. Then you've got some providers in the sort of the mid-tier space. You've got the IT2s, you've got the Kyrebas. Reval's got some enhanced capabilities that we're providing in that area. Although Reval's typically more looked at really just based on the strength of its FAS 133 accounting. In our environment, we've interacted with just about every single one of those that are out there, and the interaction between the TMS and Fire Apps is usually very, very well orchestrated. It really comes down to understanding how, what is the workflow, what level do you want to trade at, what level do you want to report at, how does it need to be accounted for, and how does it need to be allocated back to the entities where the exposure is coming from. So we found that in just about every environment, you can orchestrate a workflow that's highly effective.
Okay, great. Let me direct a question at Carl. Someone's asking for some insights on how they can create a culture of accountability for FX risk management across their company. Do you have any insights to share with us?
Sure. I think accountability really comes from, firstly, understanding the importance of financial risk in driving success. So the first thing that I would suggest is sort of a broad-based education program, firstly from the board level right on down, sort of communicating the importance of managing risk and understanding what types of activities lead to an exposure. And from there, you want to go from there to get buy-in from many different levels of the organization and make sure that people are incentivized to ensure that they're not putting risk on the books that cannot be managed. And then finally, I'd really strongly suggest that companies deploy an inclusive risk management policy that includes everyone from your traditional financial decision makers right out to the buyers and salespeople out in the field. That makes people accountable for the decisions that they make. A lot of sales guys and buyers are more than happy to cut a nice deal, but we need to make sure that they're considering the foreign exchange impact and that they're communicating that impact right back to the centralized treasury operation or the accounting authorities in charge, so that the exposures can be managed.
Yeah, and I wholeheartedly agree with everything that Carl mentioned. I think operationalizing this on an ongoing basis is very, very critical. And I've seen really two additional things beyond what Carl mentioned that have been highly effective. One is, the risk steering committee that meets, every month, that understands what's going on and reviews issues that are coming up, and that obviously has the same sort of constituents that Carl mentioned. But that's a really critical piece there, because you really want to get down to a database discussion between all of the constituents around this and get away from the anecdotal conversations. But I think that's a great way to drive it. And then the next thing that I also have seen as a best practice is when issues do arise and they kind of reach the level of unacceptable pain based on the perspective of the steering committee, having the ability to implement some of the methodologies from a Lean or Six Sigma or operational excellence to put together those cross-functional teams to go in and triage and remediate issues that they're seeing in the field. I can't tell you the number of companies I've seen in this space that have used this, because foreign exchange cuts across all elements of the organization. Having that cross-functional team discipline to go in there and resolve internal issues is the fastest way to get issues resolved and drive both the education and the accountability back into the organization.
Okay, great. I think I have more of a comment, but I think it's a fantastic opportunity for both Andy, you and Carl to comment. Just a basic comment of, treasury currencies in a steady state stay upward or downward, and hedging only smooths the impact. It doesn't eliminate that, agree. I think so. That's kind of getting at, how do you communicate, the value of hedging and why you hedge?
It's a great question. Carl, you want to take the first one?
Sure. At the end of the day, it's all about predictability. the issue is not necessarily volatility. It's the fact that an unhedged exposure creates a surprise, and that surprise means that capital investment, resource allocation, that these areas of the business are not operating at peak efficiency. So I think that the important thing is not to look at it from a market context, not to think about where the exchange rate went relative to where your position was, but to look at the fact that your business is operating more sustainably in the long term by eliminating, unforeseen exchange rate adjustments.
Yeah, I completely echo that, and just a couple of additional contexts. In most companies, foreign exchange actually represents one of the top 3 financial risks to the firm. And it is a financial risk that is completely manageable given the right aptitude and approaches to understanding and managing that risk. And one of the things you got to keep in context is most companies that are doing business international do a phenomenal amount of currency transactions on a daily basis. And if you added up all of the currency transactions, hedging, just moving cash around, doing intercompany processing, it's not uncommon for a company to do its own revenue in currency transactions on a year. And in many cases, it's actually more than their revenue passing through the cash flow cycle on currency transactions. So currencies are the lifeblood of a lot of companies. In a perfect world, we drive currency risk out of the business, and we'd all be currency agnostic. But in the real world, it is a very real issue, and it can represent one of the largest financial risks if left unmanaged.
Okay, thanks, guys. This is an interesting question. They all are. So the question is, given that there's an FX steady trend, as far as volatility goes, how do you kind of balance hedging like 12-month sales versus hedging the balance sheet? So how do you produce that mix, or how do you quantify that? Is there a trade-off between the two? Does managing one create issues on the other side, or can you comment on that?
It's kind of funny, actually, because Andy and I were just discussing this last week. And actually, I think Andy would be able to answer that best. But effectively, I think it comes down to netting out the two and really analyzing it from a macro perspective.
Yeah, it's interesting. In some cases, identifying cash flow related exposures can be relatively easy. But they can be god-awful painful to actually manage and hedge, because if you're looking at revenues, that can be highly volatile and be completely out of your control, and as such really doesn't lend itself to hedging. You start to look at certain operational costs, funding operations in an Indian call center. Those are going to be more predictable. You can see those coming, and that can make a lot of sense. But it's going to be more targeted hedging of specific cash flows. The nice thing about the balance sheet, though, at the end of the day, is that it is known. And you can learn a lot about your business just in really understanding how currencies flow through the balance sheet, because anything that happens, from a revenue or expense standpoint are ultimately going to show up as AR or AP or intercompany relationships driving exposure through the business. So we think it's a very healthy practice to really focus on the balance sheet, understand what those exposures are, use that as a catalyst to begin to think about what core flows from revenue and cost of goods sold you really understand, can build some predictability around. And the other final factor is it comes down to what is your business model and what is the risk appetite of the constituents in the firm. And we've seen companies in the same industry take diametrically opposed strategies just based on the risk tolerance of the firm.
Okay, great. We have a few more questions here. Some of these are product related, so I will let those be answered as follow-up conversations. Again, if you have a question, please enter that in the question panel. This time we still have a few more questions. I have a question, and maybe a follow-up. How do I go about, on a basic level, identifying natural hedging opportunities? Maybe that's switching to functional currency. Do you have some advice on that side?
Well, yeah, go ahead. If you want to start, go ahead, Carl.
Okay. I was just going to say that ultimately that flows outward from your long-term strategy. If you're going to be operating in a specific jurisdiction for a long period of time, you're likely to want to match match your costs and revenues with an investment of some sort. But I think Andy can speak to some of the very specific areas of opportunity there.
Yeah, no, it's actually it's a great question. And actually, one of the things that we've seen as a byproduct of a lot of the M&A activity is, as companies are buying up other companies, in some cases buying their nearest competitor, and you integrate two companies with fundamentally different functional currency strategies, you need to sit down and really think through what's the right way to do it. The nice thing about having an analytical environment like the one that we provide is that you can actually model the change of functional currencies using the same data and very quickly understand what is the change in the exposure and what is the impact. But that's really trying to do the sensitivity analysis on the impact of changing the functional currency. But at the end of the day, it's going to come down to, as Carl mentioned, the business strategy and the statutory requirements within the jurisdictions that you're doing business in. But you can very easily model what the potential impact would be if you had to make that shift.
Okay, great. Just like to close out with a question. The technology has come so far. Andy and Carl, maybe more so Andy on the technology side, what is it that you think is coming next? Is there anything on the horizon that you see coming on the technology side that's going to make this even more easier or more accessible to corporates out there to have this holistic approach?
Well, I think what you're already seeing is a lot more, just by witness of the fact that Carl and I are in this series together. There's a lot more collaboration in the market with the various component players in here, because I think people recognize today that they really don't have everything that's necessary. In fact, when Agilent Technologies went out to do their bid or their RFP for their process, they were hoping to find one place to do it all. But they very quickly recognized that they needed to come at this with the best-of-breed solution. So I think in general you're seeing a lot more collaboration with the leading providers of solutions in this area. But I do think one of the technical innovations that will come from this is more integrated dashboarding and reporting across all the component players. That's a natural offshoot of this, and we're already seeing some projects in this area where at the end of the day, you've got a single dashboard that can feed up through your executive information system. So if your CEO or CFO or COO has a question about, what's our exposure and what's our position on a day-to-day basis, they should have that at their fingertips, just like any other key financial reporting metric. So I think that you'll see a lot more drive in that arena.
Yeah, and I think we've seen an interesting shift there as well. There was a time there where it almost looked like the industry was going to move towards a model where the ERP, the TMS, and the execution platform would be rolled into one single platform. And I think what's actually happened is something more that businesses are focusing on the things that they do well. When you put a number of different technology providers into a room, they figure out how to make these things work together. And I know that that's very much the reason why Fire Apps and Western Union are working together here today, because Fire Apps offers a very strong product on the front end, and then we put something a very strong execution platform out on the back end, and they support each other. And I think that's really where the industry is going to go, as opposed to building one size fits all sort of platform.
Great. And with that, I'd like to close the Q&A. I'd like to express my thanks to Andy Gage and Carl Schmada for their valuable time and insights, and also once again to our sponsors, Western Union Business Solutions and Fire Apps, whose commitment to thought leadership allow us to offer this educational program for free. I would like to thank the audience for your valuable time and patience through our audio issues, and we will provide everyone a clean recording of the event, and also note that we will be sending out the slides as well. So with that, I'd like to thank everyone again for your valuable time and patience, and have a great day. Thank you, everyone.